Hey folks, just wanted to make a very quick video on United States Treasuries and just yield curve inversion. I'm just going to tell you my thoughts on all of this going on right now. I'm going to explain things real quick. So the US 02Y, this stands for United States 2-year government bond yield, and it's basically going to give you a chart. So what does this mean right now? This means that if you invest in 2-year notes, you're going to get 4.6%. And this is very close to the Fed funds rate, which is sitting at 4.5 to 4.75. So why is this 2-year important? It's because it's the lowest debt time frame for a note. So if you didn't know, United States Treasuries are broken into different categories. So you got bills, which is everything under 1 year with maturity under 1 year. You got notes, which is 2 to 10 years. And you got bonds, which is 10 years plus. So right here, United States 2-year is very correlated to the actual Fed's funds rate, which is sitting at 4.5 to 4.75. So right here, we're at 4.61. This means that, if I'm buying United States 2-year treasuries, I'm getting 4.61% interest. That's basically my yield on the coupon. So if I'm putting $1,000 into a bond right now, I'm essentially expected to get about $46 a year from that, is kind of what this is implying here. Now, the 10-year is also pretty important because this is basically the cutoff where everything after 10 years is a bond. So right here, we're sitting at 3.826%. So, essentially what's going on right now is that these shorter-term debt securities have a higher interest rate than these longer-term debt securities, which isn't a normal thing. If we go back in time, we can see, this is pretty strong all the way back here in time, but if we go back in time here, this is pretty weak. And we can actually calculate the spread between this by inputting a formula. We're going to type in US 10-year minus US 2-year, and then this gives us the spread between the 10 and the 2. So what this is saying right now is, hey, you know what? 2-year treasuries are giving you 0.78% more in interest versus 10-year treasuries. So this is what we're talking about when we're talking about inversion. Now this black line right here, this is the zero line. So this is when the actual inversion happens. So if we go back in time, this has happened several times. This isn't the first time, but this is the first time it's been this deeply inverted. So this is the deepest inversion that we've had in history, as you guys can see. So if we're just looking at these different time frames, this happened in 88. Right here, this was 97. This was 99. This right here was 05. This happened, let's see, where is this? That's like 2019. Yeah, so that was 2019. And guess what? We got it again. So what's actually going on? So when the Fed, when they're raising their interest rates, they're not just waving their wand and all of a sudden interest rates go up. That's not what happens. They have something called the Systems Open Market Account. So it's called Systems Open Market Account Holdings of Domestic Securities, aka SOMA. And this is basically run by the Federal Reserve Bank of New York because this is where the stock market is. So what's going on here is that they're basically offloading United States Treasury notes and bonds and United States Treasury bills amongst many other securities right here. So, if we're going back to November of 2022, we can kind of see how this progresses. So pay attention to these two numbers right here. So 296 and then 4714. Now, if I go right here, next, you can see that this number is going down. This number is also going down. So next, this number is going down, as you can see. These numbers keep going down. You can see it keeps going down, keeps going down. Where are we right now? We're at 4612,285. So notice that these numbers keep going down. So what's actually going on is that the Fed, they're offloading these holdings. So in the past, when we had the pandemic, they were buying up securities. So they were buying up securities because that is basically creating cash. It's basically flowing out cash into the economy. But right here, when they're selling these treasuries, they're essentially offering these higher yields, and people are going to take these higher yields. So that is pretty much pulling cash out of the economy. So it's pulling cash out of the economy. Now let's go ahead and let's look at this, the domestic securities holdings. So if we're just looking right here, we're clicking just the United States Treasury securities, which include T-bills, notes and bonds, FRNs, floating rate notes, and TIPS, which are inflation protected securities. So take a look right here. If we're going all the way over here, let's see, March was pretty much the top right here, I believe. So yeah, right around here, this is the top. And since then, we've just been falling. But take a look right here in 2020. So right around 2020 right here, we had a significant jump. And this was because, the Fed, they were essentially stimulating the markets by buying up all of these securities, pretty much dropping rates down to like record bottoms and creating easy money scenarios. So right now, we're seeing the opposite of that. And if we're just looking at the holdings, the holdings basically increased almost double, like more than double here. So look right here. In 2017, it was about like 2.5 billion. Or no, not 2.5 billion. That's like 2.5 trillion. So yeah, that's like 2.5 trillion right here. All the way up here, it's like 5.6 trillion. So that's like double and then some. So, what happens if they try to offload a lot of this? Because right now there's a lot of glut here. There is a lot of glut. So, they're probably going to keep offloading this. And, that's going to pretty much boost up these yields right here. So, the 10-year, the 2-year, these are all going to go up as they continue these interest rate hikes. But here's one thing to keep in mind. Imagine you're a boomer. So you're a boomer, you're about to retire. Do you want to be heavily invested in 2-year notes and not in longer term yields? Because what's going to happen in 2 years? Well, you're going to get your money back and then you're going to get the interest for 2 years. But then let's say that the Fed drastically cuts rates. Well, if the Fed drastically cuts rates, then you're not going to be able to lock in a better yield at a future time when these maturities expire. So what might be attractive for somebody who's older and going into retirement? They might want a 10-year yield where they could lock in, 3.83% for the next 10 years. That might be very, very attractive to them. These 2-year treasuries, they might not be that attractive for these older investors. Maybe if you're like a Gen Z or you're like a millennial and you want to see your money come back right back to you and you just want short-term interest, this might be very, very attractive to you, but it's not as attractive for the older investors because they're always looking for yield. They're not going to be able to work, when they're in their 70s or when they're 80s. They're looking for passive income sources. So they want like rental income, they want social security benefits. They want United States treasuries that are going to pretty much set them at a strong yield. So if we're just looking back in time, we could put moving averages on this as well. If we're looking at the last 200 weeks, the yields were about 1.85%. The last 50 weeks, the yield was about 5.25%. So, just to prove that, I'm on the 5-year chart. Or actually, maybe I got that wrong. So if I'm looking at the 5-year chart, the last 200 weeks was 1.85%, and the last 50 weeks was 3.25%. So this is kind of giving you some insight that, hey, you know what? 200 weeks ago, this is pretty much the average of those last 200 weeks. So we're well above this average, and maybe, this might not be a bad idea to lock in some longer term yields. Because obviously, if you're older, you want that passive income. And who knows, maybe in the next 2 years, yields might not be as attractive. So if we're just looking back here in the pandemic times, yields dropped all the way down to like 0.5. Now look what happens on the 2-year. If we're looking right here, the yields, they're pretty much zero. It's like 0.1%. So, at the very bottom, it's like 0.1%. At the very bottom right here, it's like 0.5%. So as you guys can see, when they cut rates, this 2-year goes down much, much faster than this 10-year. And that is how we recover from this inverted yield curve. So as you guys can see, we recover very, very fast because when the Fed cuts those rates, they cut it rapidly. They're cutting it rapidly. So you guys can see, we go whoop, inverted, bam, right back to positive. So hope you guys enjoyed this video and have a good one.